as you stack your edges, your probability or expectancy of a positive outcome increases. And you can also position size that name a little bit higher than the other names that don't exhibit the edge. If you track stocks on a relative basis to the market, when the environment is good, your probabilities of success are higher. That's just math. And when the environment is bad, your probability of success is lower.
When the group is acting well together, that's going to increase the probabilities of a move individually into one of the stocks.
One thing you could do for yourself is just pick any downtrend in the market in the past and look for relative strength examples. It will solidify that concept.
So relative strength edge, we just did a recent webinar kind of completely about this and kind of what we look for. But, very plain and simply, we're looking for stocks that can outperform, and they leave clues, especially when the market is coming in, whether it's a longer bear market or correction, that we can notice and keep track of so that they're on our watch list once that correction is over. So we've got a few listed here, relative strength, new high before price. That's when looking at relative peaks. Maybe the stock isn't making a new high, but the relative strength line, which is just the ratio of the stock to the index, is. And what that tells you is the stock is holding up a lot better than the market, a lot better than all other stocks. And it's showing that outperformance, showing that accumulation by institutions. And when that market pressure lifts, that's when it can take off. RS zone, RS phase, this is where, the stock is in an uptrend, the RS line is an uptrend, another key characteristic that we look for. And RS days, right? That's kind of your specialty during corrections, counting the number of days where the stock on a relative basis is outperforming. Maybe it's even down, but it's outperforming in some way. And I think your study said over 61% of days. That's what you're kind of looking for.
60 to 63%. If a stock is exhibiting relative strength 60 to 63% of the time while the market is officially in a corrective phase, let's just say breaks 21 day, those stocks tend to be the leaders on the next cycle. That's just the stat.
Yep. And Privilege says 61.8 is a fib number. So who knows?
The universe revolves around that. That's your whole.
Yeah. So the whole rationale behind relative strength, and some people say relative strength, by the time you know it's relative strength, it's over. I completely disagree. I think you just have to look for the subtle signs, right? You're looking for low down in the base when the correction is happening. You're trying to build a case for a stock every single day and trying to add different characteristics to it. So I think a lot of people in here are probably already familiar with relative strength. We'll maybe link down below the relative strength webinar we did. I think we can move on from here since we're already almost 2 hours into this thing. So, and we got a lot more.
Yeah. So here's some examples. The super obvious ones you will find in the 2020 market, right? The COVID crash or COVID pullback, COVID whatever market you want to call it. The relative strength line makes a new high as price trades below the recent high that we're comparing. This is one of the best signatures in the market. I know we researched Amazon. This is Amazon, by the way. We put on a position right through this consolidation and rode it all the way up from this 2020. And that's a simple, we're identifying what stocks are holding up as the market pulls back in. And it's as simple as that. And then you identify pivots, which we'll get into the depths of very, very quickly in the next webinar and framework. And then, you can then manage your risk. And then people get into, hey, I'm in a winner. How do I get out of it effectively? We'll cover that as well in subsequent webinars. So this characteristic is the relative strength line is making a new high, or the relative strength line is going up as the market goes down. Learn to identify this characteristic. All it's saying is we're expecting the stock to go down a lot more than the market because the beta of this stock is 2x the market. It is not doing that. It is not going down as much as the market's going down. That causes the relative strength line to go up. I know folks that say relative strength line doesn't work. They don't use it. They have other means of identifying it. And all they're doing is quantifying relative strength in a different way at the end of the day. So, if you put in a higher low as the market made a lower low. What is that? It's relative strength. The market made a lower low and the stock did not make a lower low, right? So it's just a different way of saying the same thing. If a stock is strong, if VRT is above the 10-day, as the S&P and the Qs are breaking, you can pull up VRT on your end. That's a relative strength. As APP is trading above the 10-day, as the S&P and Qs are below the 50, that's relative strength. As CELH is trading above the 10-day and the S&P are below the 50 and the Qs, that's relative strength, right? Those stocks that exhibit and don't trade with the markets, even though the market has some level of influence, always has some level of influence on every stock. They're not doing that. There's some level of accumulation that's happening. And that's most severe and mostly magnified when markets go into correction, right? And you could take that stat, stocks that exhibit 60 to 63% relative strength, right, as the market goes into correction, are the leaders. SE did this, Zoom did this, Amazon did this, Roku did this, PLTR did this, just in the recent COVID correction. You go back number of trends, OKTA, Coupa Software, Squarespace, Square, those were the 2017-18 correction. You go even more back in time and you, let's say, get closer to 2015, all the steel stocks when we had a correction acted well, and some of the smaller ones doubled. The cannabis, so this is off the top of my head. You study these cycles, you know these things in the back of your head. If you don't do this for yourself and you're waiting for me to tweet it or Richard to tweet it or anybody to give you, some sort of help on Twitter, it's not going to work. You need to know these, over time as you study different market cycles. These are things that you just say at the end of the day. So we have another example. This one points more to the longer. I know this stock is AHR for a fact, because this one had the highest volume edge, doubled, and then held around 5. Very similar to Arlo. It looks exactly the same as Arlo. If you were to take AHR at $5 and Arlo at $5, this one doubled from there, and it exhibited. How did it get on our radar? It got on our radar with the highest volume edge, right? The next concept is, as the market came down, this held the 10-day. As the market pulled back, this continued to rise. And when you see this relative strength, even if you miss the HV edge and you can't pick it over here at 5, and you see that this stock held at 10, I traded it over here. I traded it over here based on relative strength alone, combined with my high volume. Now I have 2 edges. And when we get into position sizing, this becomes important, right? But this one continued to go higher from 10 to 20, 5 to 20, whatever you want to call it, but it exhibited relative strength. That's our second edge that we look for, or our second characteristic that we look for in the markets. So let's get into some live examples of this concept and see how the markets exhibit this. I'm just going to pull this up.
Yeah, and while Rye is doing that, leave in the chat right now or in the comments any questions you have about the RS Edge. We'd love to hear it. And again, we'll try to answer as many as we can. And there's a question from Parv, who I think it's a pretty good question. Do you look for RS in a sector and then find stocks in that sector, or just scan each stock individually? Thanks. I personally favor a kind of bottoms up approach where I'm going to stocks first, and then I'll notice trends in the industry group and then the sector. Some people I know, Jack Alpha Charts, he likes looking at ETFs and favors a top down where he's looking at the ETFs, identifying which are showing strength. You can go either way, and I know Rye, you've actually got all your ETFs. They'll both confirm the same thing. This past weekend we've noticed strength in software, we've noticed strength in oil and gas, and the stocks are showing that. And that's why the ETFs are showing that. So you can pick it up either way. It's about finding an approach and routine that works for you, your time constraints, all of that. Top down might be a little bit faster for people who have less time, but you might not be able to find every single, the best opportunity in the group. It kind of depends on what you want. So I don't know. I think that's all I was going there. Ryan, anything to add on that, or? Is that good?
Yeah, I tend to if I scan for relative strength, so if we just go here and we go to technicals, we have these pre-built scans, relative strength 1, 3, 6, 9, and 12 month in deep view. I can go through these and look for stocks that are exhibiting this relative strength new high before price 1, 3, 6, 9, and 12. I tend to do that, and it will give me a sign of which industry group is holding well, right? Another way I do this is I just have an ETF list. And if I take this ETF list and I sort it by AS score, and I say uranium is acting well in the market, software is acting well in the markets, cloud computing is acting well. This alone tells me in the last 20 days, what's going on? Where's the rotation? Just like that, right? It's a very quick way. Now I can, yes, dig into what's inside XLE that's acting well, what's inside IGP that's acting well, etc. People do it that way or the other way. Look at stocks and then come to the conclusion that uranium, software, cloud computing, oil and gas are acting well. You could do it both ways. It's more personal preference. As long as you come to the same conclusion, it doesn't really matter how you do it at the end of the day. So let's go over relative strength examples, and we picked a recent market just to showcase this. So CELH. So we know that if we go to, let's just go to the Qs, and the Qs are pulling back from July 23, or sorry, July 19. They're pulling back, right? They're off of their highs. They came back in, whatever. Let's go back to CELH and say July. What is it doing in July, right? So this stock came up. So if we take a relative reference of what CELH is doing in the markets, it also pulled back with the markets, but it gapped up from that point, right? So now it's outperforming. It's in a relative strength phase. We call this a relative strength phase because on a 21-day basis, CELH is outperforming the S&P. Or if I place the Qs on here, if I go to settings, put Q, right? And I compare this, CELH is outperforming the Qs on a 21-day basis, and that's what this is showing. This blue shade to the top side is showing that this is in a relative strength phase. Recently, as we saw turbulence in the markets, let me get rid of these alerts. I can place them on later. This 10-day CELH continues to go higher as the market pulls back in, right? So that's relative strength. That's relative to the market, relative to the Qs. The RS line continues to rise, even though the Qs are pulling in the QPQ. So that's one example. Very simple observation. Now imagine combining that with this HV, right? You have HV, then you have relative strength. You combine those, you increase your probability of having a positive expectancy in the markets that will yield an eventual positive return and increases your chances from going to stage 2 to stage 3. Just those two things alone. So let's talk about this. I mean, this ETF, same thing. It's a relative strength phase. It moved higher as the Qs came in. That's what the relative strength line is rising. So if I were to zoom in, I picked an ETF on purpose just to show that this concept is not just for stocks. It could be for ETFs as well. So whatever, this ETF is holding is outperforming the markets because the RS line is rising, and in a relative strength phase on a 21-day basis, the components of this ETF are outperforming the markets. Lilly, LLY, is a good example. This one has a really good story now. Continues to hold the 10-day, right? As the market was pulling back in and the relative strength line continues to rise. Got super tight right in here. You define your pivot, etc. We'll get it back. We'll get into those in subsequent frameworks, and then we move up and out from there. So VRT, same thing, continues to hold the 10-day, rising RS line, acting well. And same thing, you're visually identifying HV, highest volume, this stock is exhibited in a year ever IPO, etc. Then you start to track it, and there's a secondary edge. It's exhibiting relative strength. It's in a relative strength phase. It's outperforming the market.
It's 12 o'clock.
And what we will get into when we discuss position sizing is you stack your edges up. And as you stack your edges, your probability or expectancy of a positive outcome increases, And you can also position size that name a little bit higher than the other names that don't exhibit the edge, which is basically a winning characteristic that you look for in the markets. ZS. So ZS has been acting well recently. So it's in a relative strength phase on a 21-day basis. It's outperforming the markets and it's now exhibiting relative strength as it consolidates as the market pulls in. The QQQ is trading close to the 50-day. The ZS is trading above the 10-day. That's also relative strength, right? It's relative to what the market is doing. Some people tend to not look at the markets at all. They say, set up. All I need is a consolidation tight setup. And if it moves, I'll do that. That's one way to do it. But if you track stocks on a relative basis to the market, when the environment is good, your probabilities of success are higher. That's just math. And when the environment is bad, your probability of success is lower. So relative to the market, ZS is outperforming. That's another example of relative strength.
Yeah, and here the group is acting together as a whole and showing RS together. And for me, that's kind of another edge that you can layer on. When the group is acting well together, that's going to increase the probabilities of a move individually into one of the stocks. So that's another edge that you can add to your toolbox. And Stan Weinstein, of course, mentions that so many times in his book and in the masterclass as well. All right. You're bringing back up the presentation?
Yes.
Yep.
So we got the presentation. Those were live examples of relative strength. There's study. So one thing you could do for yourself is just pick any downtrend in the market in the past and look for relative strength examples. It will solidify that concept, right? In the back of your mind when you're trading real time, hey, this stock has exhibited relative strength. The likelihood of this, the pressure lifting off as the market goes up, it will give you that confidence to see those examples, document them for yourself, build yourself some model books and some live examples. Could be 10 per cycle, 15 per cycle. Anything more than 0 will always add to your confidence at the end of the day.